Today, we're going to be discussing Chapter 8. And Chapter 8 is dealing with how organizations define their financial goals by preparing numerous budgets that collectively form an integrated business plan known as a master budget. The master budget communicates management's plans throughout the organization, allocates resources, and coordinates activities. Okay, so a budget is a detailed quantitative plan for acquiring and using financial and other resources over a specified forthcoming time period. A company's budget ordinarily covers a one-year period that corresponds with its fiscal year. And some companies also use a perpetual budget, which is a 12-month budget that will continually roll forward. So operating budgets ordinarily cover a one-year period corresponding with the fiscal year. And then many companies will divide their annual budget into different quarters. And then a continuous budget is a 12-month budget that rolls forward 1 month or quarter as the current month or quarter is completed. Now, the differences between planning and controlling. Planning involves developing objectives and preparing various budgets to achieve those objectives. And controlling involves the steps taken by management to increase the likelihood that the objectives set down at the budgeting stage would be attained, and that all parts of the organization are working together towards that goal. So why organizations create budgets? Budgets communicate management's plans throughout the organization. Budgets force managers to think about and to plan for the future. The budgeting process provides a means of allocating resources to those parts of the organization where they can be used most effectively. The budgeting process can uncover potential bottlenecks before they occur, and budgets coordinate the activities of the entire organization by integrating the plans with its various parts. And budgets also help to define goals and objectives that can serve as benchmarks for evaluating subsequent performance. From a control standpoint, organizations compare their budget to actual results in order to improve the efficiency and effectiveness of operations and to evaluate and reward employees. One thing to note is that budgets are prepared for reasons other than projecting income and balance sheet balances. And so there's other information that might be provided by budget, such as determining the need for short-term borrowing or for estimating the raw material needs. So there are different reasons how the budget contributes to a lot of different areas within the organization. So how do organizations create budgets? Companies usually create budgets by relying on some combination of top-down budgeting and self-imposed budgeting, meaning there's some inputs going to be provided by people at the top or top management, and then it's going to trickle down. But some will be done within the organization as well. So a self-imposed budget, or what is called participative budget, is a budget that is prepared with the full cooperation and participation of managers from all levels. So the self-imposed budget. A self-imposed budget or participative budget is a budget that is prepared with the full cooperation and participation of managers at all levels. It is a particularly useful approach if the budget will be used to evaluate managerial performance. The advantages of self-imposed budgets include that individuals at all levels of the organization are viewed as members of the team whose judgments are valued by top management. Budget estimates prepared by frontline managers who have intimate knowledge of day-to-day operations are often more accurate than estimates that would be prepared by top managers. Motivation is usually higher when individuals participate in setting their own goals, when the goals are rather than the goals being imposed from above. And a manager may not be able to meet a budget imposed from above, can claim that it was unrealistic. The self-imposed budget eliminates that excuse because it's going to be what they contributed to. Self-imposed budgets should be reviewed by higher levels of management. Without such review, self-imposed budgets may have too much budgetary slack or may not be aligned to the overall strategic goals. Most companies do not rely exclusively upon self-imposed budgets in the sense that top managers usually initiate the budget process by issuing broad guidelines in terms of overall target profits or sales. Lower level managers are directed to prepare budgets that meet these targets. Okay, the master budget, an overview. The master budget consists of a number of separate but interdependent budgets. The sales budget shows the expected sales for the budget period expressed in dollars and units. It is usually based on a company's sales forecast. All other parts of the master budget are dependent upon the sales budget. The production budget is prepared after the sales budget. It lists the number of units that must be produced during each budget period to meet sales needs and to provide for the desired ending inventory. The production budget, in turn, directly influences the direct materials, direct labor, and manufacturing overhead budgets, which in turn enable the preparation of the ending finished goods inventory budget. These budgets are then combined with data from the sales budget and the selling and administrative expense budget to determine the cash budget. The cash budget is a detailed plan showing how cash resources will be acquired and used over a specified time period. All of the operating budgets have an impact on the cash budget. The last step in the process is to prepare a budgeted income statement and a budgeted balance sheet. To help you see the big picture, keep in mind that the 10 schedules in the master budget are designed to answer the 10 questions as shown. So the 10 questions that it's going to help answer is how much sales revenue will we earn? How much cash will we collect from customers? How much raw materials we would need to purchase? How much manufacturing costs we will incur? How much cash we will pay to our suppliers and our direct laborers? And how much cash will we pay for manufacturing overhead resources? What is the total cost that will be transferred from finished goods inventory to cost of goods inventory? How much selling and administrative expense will we incur, and how much cash will we pay related to these expenses? How much money will we borrow from or repay to lenders, including interest, and how much operating income will we earn? What will our balance sheet look like at the end of the budget period? It also bears emphasizing that a master budget is based on various estimates and assumptions. For example, the sales budget requires 3 estimates and assumptions as follows. What are the budgeted unit sales? What is the budgeted selling price per unit? What percentage of accounts receivable will be collected at the current and subsequent period? When Microsoft Excel is used to create a master budget, these types of assumptions can be depicted in a budgeting assumptions tab. whereby enabling the Excel-based budget to answer what-if questions. And budgets, particularly in large organizations, can be very complex. To keep complexity within bounds, we have simplified the budgets. Even so, these simplified budgets are intricate, and the level of detail may be overwhelming for some of you. So just remember that each step in the process is fairly simple, but the budgets must fit together for the plan to be successful. So you can look at Exhibit 8.1 from time to time to review the master budget interrelationships. So then we'll work on preparing the master budget. And the first area that we're going to look at is the sales budget. So we're going to assume the facts shown about the Royal Company. So they will be preparing budgets for the quarter that will end on June the 30th. And then sales for the next 5 months are going to be as follows. So for April, 20,000 units, May, 50,000 units, June, 30,000 units, July, 25,000 units, and August, 15,000 units. And the selling price is $10 per unit. So the sales budget multiplies the budgeted sales in units for each month by the selling price per unit. So the total sales budget for the quarter is 1 million. It's calculated by multiplying the budgeted sales in units for the quarter, 10,000 by 100,000 by the selling price, which is $10. And so they break it down for April, May, and June, which is part of that quarter. The number of units multiplied by the number of sales, the sales price, and then you can get that. To simplify the computation of expected cash collections in the illustration, we assume that the company's bad debts are negligible. So we're going to assume that they don't have a lot of bad debt. Now, assume the information as shown regarding Royal's expected cash collection. So Royal's collection pattern is that all sales are going to be on account, and that 70% are going to be collected the month of the sale, and then 30% will be collected the month following the sale. And so for an April, the March 31st accounts receivable balance of 30,000 would be collected in full by April. So the first step is to calculate cash collections, is to insert the beginning accounts receivable balance, which is 30,000, into the April column in the cash collection schedule. This balance will be collected in full in April. The second step is to calculate the April credit sales that will be collected during each month in the quarter. So 70% of 200,000 they're going to collect in April, and then 30% of it they're going to collect in May, and we see that. The third step is to calculate the May credit sales that would be collected during each month. So 350,000, which is 500,000 times 70%, would be collected in May, and then 150,000, which is 500,000 times 30%, would be collected in June. So what would be the total cash amount that would be collected in for the quarter? It would be 940,000. Because remember, of $1 million in sales, 70% of it would be collected. What you just have to work it out how we did it. Okay. So once you do June sales, it'd be 70% of June sales, because the rest of June sales would be in July. So it'd be 940,000. And so the fourth step would be to calculate the June credit sales that will be collected during the month of June. So 210,000 or 300,000 times 70% would be collected in June. And then the fifth step then is to calculate the total for each column in the schedule, and then the total for the quarter. Okay, so now we're looking at how to prepare a production budget. So the production budget must be adequate to meet budgeted sales and to provide for the desired ending inventory. So again, we'll look at an example. So assume the information as shown to enable the production of Royal's production budget. If Royal was a merchandising company, it would prepare a merchandise purchases budget rather than a production budget. So because this is a manufacturing company, we're doing a production budget. If it was a sales company, it would be a merchandise purchase budget. But we're going to assume that they want their ending inventory to equal 20% of the following month's projected sales. So for March 31st, 4,000 units were on hand. And so we'll prepare our production budget. So the first step is to prepare the production budget, is to insert the budgeted sales in units into the sales budget. So for April's 20,000, 50,000 for May, 30,000 for June, 100,000 for the quarter. Now, the second step is to calculate the required production in units for April, which is 26,000 units. So notice that the desired ending inventory in units for April would be 10,000, and the beginning units for April is 4,000. Because the desired ending inventory is going to be 10,000 because they figure that for May that they're going to have 50,000 in sales times 20% is going to be 10. So that's what we want at the end. So they have to produce 30,000 units. They already had 4,000 left from the prior month. And so the required production is 26,000. So quick check. What is the required production then for May? And it would be 46,000 units. And we see that as follows. So you're going to have in the following month for May, you're going to have notice that April's desired inventory is 10,000, which becomes the beginning inventory for May. So we take 20% of 3,000, which is the 6,000, and we have the 50,000 sales plus the 6,000 units is 56,000, but we have 10,000 units that we're going to bring over from April. So then we need to produce 46,000 units. And then for the quarter, then and then the next step would then be to go ahead and calculate for June. The 29,000 units is what they have to produce. Notice that we are assuming an ending inventory of 5,000 units, which would be implied, which implies that sales for July are at 25,000 units. And then the fifth step is then to go ahead and complete the quarter column. And so April's beginning inventory and June's ending inventory are carried over to this column. And sometimes what students like to do is they'll add up the inventory amounts instead of using the correct ending and beginning inventory figures. And that's not what you want to do. You just want to go ahead and carry over the amounts. Okay, and then we'll look at preparing our direct materials budget, including the schedule for expected cash disbursements and purchase of materials. So again, we're going to look at the Royal Company. So assume the information as shown to enable the preparation of Royal's direct materials budget, which quantifies the amount of raw materials that must be purchased to fulfill the production budget and to provide for adequate inventories. And so we'll look at this. So at Royal, 5 pounds of material are required for each unit. Management wants material on hand at the end of each month to equal 10% of the following month's production. So on January, excuse me, on March the 31st, 13,000 pounds of material were on hand, and the material cost is 40 cents per pound. So the first step in preparing the direct materials budget is to insert the required production in the number of units. So we see that for April, we're going to have to produce 26,000 units, 46,000 units for May, 29,000 units for June. The next step is to calculate the monthly and quarterly production needs, which in this case are stated in the terms of pounds. So we said that each unit takes 5 pounds. So you multiply the number of units to be produced by 5 pounds a unit. So you come out with, for April, 130,000 pounds, May, 230,000 pounds, 145,000 pounds, and 505,000 pounds for the quarter. Now, the next step, the third step, is to calculate the materials to be purchased for April, which is 140,000 pounds. And the reason for that is that the desired ending inventory of 23,000 pounds is 10% of the following month's production. So 230,000 pounds. The desired inventory we need to have is 23,000. So we'd have to add that to the 130. So we need 153,000, but we had at the end of the month, we had 13,000. So we subtract that. So we have to purchase 140,000. Now, how much material should be purchased in May? And it would be 221,500 pounds. And we get that by the fourth step is to calculate the amount of pounds that would need to be purchased for May. And so we noticed that April's desired ending inventory would become May's beginning inventory. So the ending inventory for April, 23,000, becomes our beginning in May. And then we can calculate that out. And then the fifth step is to work out for June. And so for June, it's 142,000 pounds, and to calculate the annual totals, we're assuming that the desired ending inventory for June is 11,500 pounds. And in April's beginning inventory and June's ending inventory would carry over into the quarter column. So one thing to note is that the inventory purchases budget, or the raw materials purchase budget, are really just the elements of a cost of goods sold schedule in a different order. So now we can assume the following information regarding the cash disbursements for materials, how we're going to pay for materials. So we know that Royal pays 40 cents a pound for its materials. 1/2 of a month's purchases is paid in a month of the purchase. The other half is paid in the following month. And so for April 31st, the accounts payable balance is 12,000. So the first step is calculating Royal's cash disbursements, is to insert the beginning accounts payable balance of 12,000 into the April column of the cash disbursement schedule. This balance will be paid in full in April, because that's what's remaining for March, and that's what they're going to pay in April. Now, the second step is to calculate the April credit purchases that will be paid for in each month of the quarter. So 28,000, which is 56,000 times 50%, will be paid in April, and then 28,000 will be paid in May. And we got that from knowing how many units, and then just we get that. So it's 100, the number of pounds times 40 cents a pound is how we get that. And then remember, they're only going to pay half of it in the current month, half of it in the following month. So what would be the cash disbursement total for the quarter? and that would be 185,000. So the remaining, and again, you can work that out then for May, and then you're only for June, only paying one half for June. And then the other remaining portion would be paid for in the next quarter. So the remaining steps include calculating May and June's credit purchases and how they're paid, going to be paid each month of the quarter. And then calculate the total of all of the columns in the schedule and the total for the quarter, which is 185,000. Next, we'll look at the direct labor budget. Assume the information as shown to enable the preparation of Royal's direct labor budget, which enables the company to match its direct labor hours provided with its production needs. And so each unit uses 0.05 hours or 3 minutes of direct labor. The labor can be unskilled because the production process is relatively simple and formal training isn't required. And so because of that, Royal pays its workers a rate of $10 an hour. So the first step is in preparing the direct labor budget is to insert the production in units from the production budget. So we get that from the production budget, 26,000 for April, 46,000 for May, and 29,000 for June. The next step is to compute the direct labor hours required to meet those production needs. So we take 0.05 hours, multiply by the number of units, and we get the number of hours that are required. The third step in this particular example is to compute the direct labor hours paid. So that number of hours times the hourly rate, which in this case is 10, and you can get that. The fourth step is to compute the total direct labor cost, which we assume is paid when it's incurred. Notice that with direct labor, we computed all 3 months at the same time. This is because there's no beginning and ending inventory amounts to consider. So what would the total direct labor cost for the quarter be if the company pays time and a half, which would be 10 times 1.5 or $15 for all hours worked by employees over 2,000? And it would be 52,000. And again, you can break it down. So the regular hours worked, and then if it's more than the 2,000 hours, they have to work overtime. So working that out. So prepare the manufacturing overhead budget. So we're going to assume the following information as shown to enable the preparation of Royal's manufacturing overhead budget. This budget provides a schedule of all of the cost of production other than direct materials and direct labor. So the first step, okay, so for them, we said that variable manufacturing overhead is going to be $20 per direct labor hour. Fixed manufacturing overhead is going to be $50,000 per month, which includes $20,000 in non-cash costs, which would be the depreciation on the plant equipment. So the first step in preparing the manufacturing overhead budget is to calculate the variable manufacturing overhead costs for each month and in total. Notice that the direct labor hours required is taken from the direct labor budget. So we take the number of hours, we get that from the direct labor budget. Now, the second step is to add the fixed manufacturing overhead cost, which is the $50,000 per month, to the variable overhead costs to arrive at the total manufacturing overhead costs for each month and in total. Notice that we can determine the predetermined overhead rate for the quarter, which is $49.70. Once the level of fixed costs has been determined in the budget, the costs really are fixed. Hence, the time to adjust fixed cost is during the budgeting process. So we see that we take the number of hours for the quarter, our number of manufacturing overhead for the quarter divided by the total hours required, and that's how we get the amount per hour. Now, the third step is to calculate the cash disbursements for manufacturing overhead by subtracting non-cash expenses from the total manufacturing overhead costs computed in step 2. And in this example, 20,000 of depreciation is deducted from each month's total overhead costs to arrive at the cash disbursements for the manufacturing overhead. Because remember, 20,000 of it is non-cash, so we wouldn't consider that. Okay, so now we're going to look at the ending finished goods inventory budget. So now Royal can complete the ending finished goods inventory budget. The first step in preparing this budget is to compute the direct materials cost per unit, which is $2, because they use 5 pounds of material times 40 cents a pound, comes out to $2. This information needed can be derived by referring back to the direct materials budget. The next step is to compute the direct labor cost per unit, which is 50 cents, because it's 0.05 hours at $10 an hour. So that's 50 cents. This information needed likewise can be derived from looking at the direct labor budget. The third step is to compute the manufacturing overhead cost per unit, which is $2.49, and the total inventoriable cost per unit, which is $4.99. Note that Royal is using an absorption costing approach to value its inventory. The quantities shown are direct labor and manufacturing overhead are the same 0.05 hours, because direct labor hours is the overhead allocation base. The predetermined overhead rate was calculated when we prepared the manufacturing overhead budget. The fourth step is to calculate the value of the ending goods inventory, which in this case is 24,950. And we get that by taking the number of units, ending inventory units, which is 5,000, multiplying that by the unit product cost, which is $4.99. And that's how we come out with 24,950. And as I say there, so the 5,000, we get that from the production budget. And then we have the amount that we already calculated. We can figure that out. All right, the next thing that we're going to look at is our selling and administrative expense budget. So we're going to assume that the information as shown to enable the preparation of Royal's selling and administrative expense budget. This budget lists the budgeted expenses for areas other than manufacturing, and is typically a compilation of many smaller individual budgets. So we see that at Royal, the selling administrative budget is divided into variable and fixed components. The variable selling and administrative expenses are 50 cents per unit sold. Fixed selling and administrative expenses are 70,000 per month, and that the fixed selling and administrative expense include 10,000 in cost, which is primarily made up of depreciation that is not a cash outflow of the current month. Let's prepare the company's selling and administrative expense budget. So the first step is to prepare this budget is to multiply the variable S&A rate, which is 50 cents, by the total number of units sold. So $20,000 times, or 20,000 units times 50 cents comes out to 10,000 in variable expenses. The second step is to add in the fixed S&A expenses, which is 70,000. So that gets you then up to 80,000 total S&A expenses. The third step then is to deduct non-cash S&A expenses, which is 10,000, in order to arrive at the cash disbursements for S&A expenses. So really it's 80, but of that is 10,000 of it's non-cash, which is the depreciation. So really the cash expenses for the month are 70,000. So quick check. What are the total cash disbursements for selling and administrative expenses for the quarter? And it would be 230,000. So the same steps are followed for the months of May and June to arrive at the total cash disbursement for S, G, and A expenses for the quarter, which is 230,000. So you're just going to do that for each month. You're going to look at what the projected sales unit number of units were times the rate, and then that'll give you, and you can work it out for each month. Okay, so the next step is to look at doing the cash budget. The format of the cash budget. This budget should be broken down into time periods that are as short as possible. It consists of 4 major sections. The cash receipts section lists all cash inflows, excluding cash received from financing. The cash disbursements section consists of all cash payments, excluding repayments of principal and interest. The cash excess or deficiency section determines if the company will need to borrow money or if it will be able to repay funds that it had previously borrowed. And the financing section details the borrowings and repayments projected to take place during the next budget period. Now, the idea of the cash budget should cover time periods as short as possible should be understood by students with checking accounts. Fluctuations in cash flow can cause a negative balance during the month, even though the balance is positive at the beginning and the ending of the month. You know, there's going to be times where you might go low or end up going in the negative, even though at the end of the month and at the beginning you might be positive. So that's why we do that. So the first thing we're going to do is to assume the information as shown to enable the preparation of Royal's cash budget. So we're going to assume that they maintain a 16% open line of credit for 75,000, that they maintain a minimum cash balance of 30,000, that they borrows on the first day of the month and they repay the loan on the last day of the month, that they will pay a cash dividend of 49,000 in April, and that they will have purchases of 143,700 of equipment in May and 48,300 in June, that both will be paid in cash, and that for April 1st they have a cash balance of 40,000. So the first step in preparing this budget is to calculate the total cash available, which is 210,000. So you have and then of that, notice that the cash collections for April, which is 170,000, come from the schedule of expected cash collections that we looked at earlier. So we have a beginning cash balance of 40,000. We're going to have cash collections of 170. So we're going to have total cash available of 210. The next step then, the second step, is to calculate the total cash disbursements, which is 228,000. Notice that each cash disbursement except dividends will come from the schedule or a budget that had already been prepared. The dividends, they just told us that. So the materials, the 40,000, direct labor, 13,000, 56,000 of manufacturing overhead, 70 of S&A. And then for April, they're not purchasing any equipment, and then they have a dividend. So 228,000. So the third step then is to calculate the excess or the deficiency, that is, and they're going to have a deficiency of 18,000. So because Royal maintains a cash balance of 30,000, the company must borrow 48,000 from its line of credit. Now, okay, so the fourth step is to determine the financing requirements and the ending cash balance. And again, remember that Royal has to maintain a $30,000 cash balance. So because of that, it's going to have to borrow 48,000 from its line of credit. The ending cash balance, 30,000, coincides with this minimum requirement. The ending cash balance for April will carry forward to become the beginning balance in May. These 4 steps are then get repeated during the month of May. But since Royal must maintain a minimum cash balance of 30,000, it's not going to repay the loan in May. We see that then for May, we do that. So now, what would be the excess or deficiency in cash for June? And it would be 130,500. So we're going to do the same thing then, work it out for June. And so the result is an excess of cash available of 130,005. This excess will enable Royal to repay the 48,000 in principal that it borrowed, plus the interest of the loan, which would be 1,920. So 48,000 times 16% times 3/12. With the ending cash balance for the quarter would be 80,580. And so the next step then is to go ahead and prepare a budgeted income statement. So the budgeted income statement, once the cash budget has been completed, the budgeted income statement can be prepared. The cash budget must be prepared first so that the interest expense can be determined for the budgeted income statement. The numbers from the budgeted income statement come from other budgets that have already been prepared. More specifically, the sales revenue comes from the sales budget. The cost of goods sold on a per unit basis comes from the ending finished goods inventory budget. The selling and administrative expenses come from the selling and administrative expense budget, and the interest expense comes from the cash budget. Now, for simplicity, income taxes are not included in these budgets, but taxes must be considered in the company's budgeting process. And then doing the balance sheet, a budgeted balance sheet. So we're going to assume the following information to enable us to prepare the budgeted balance sheet. So Royal reported that they had the following account balances prior to preparing its budgeted financial statements. So they had land of 50,000, common stock of 150, retained earnings of 248,650 as of April the 1st, and they had equipment of 175. So the budgeted balance sheet is prepared as follows. So cash is going to be 80,580. That gets taken from the ending cash balance of our cash budget. The accounts receivable of 90,000 is 30% of June's sales of 300,000. The raw materials inventory of 4,600 is calculated by multiplying the ending inventory of raw material in pounds, 11,500, by the cost per pound, which is 40 cents. The finished goods inventory of 24,950 is taken from the ending finished goods inventory budget. The land, equipment, and common stock are all given. The accounts payable of 28,400 is 50% of June's purchases, which is 56,800. And then we have to calculate then what our ending retained earnings balance is. And the ending retained earnings is 438,730, is calculated by adding in the net income of 239,080 to the beginning retained earnings of 248,650, and then subtracting our dividends that we're paying out of 49,000, and that gets you the ending retained earnings. And so we see there then that everything balances, so we know we're good. And so those are how you would go ahead and prepare all of your various budgets for a corporation.